Hello, my name is Eddie Tofik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Paris milling wheat. There had been here one continuing dominant pattern, a quite large pattern that 13 weeks ago took a break on the downside. It is of course the dark blue highlighted late August 2024 to late February 25 ascending triangle pattern. This pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it. The main pattern can be clearly seen on my daily chart. 14 weeks ago I laid out targets below for this pattern, and I quote, "A primary target X will be in the 226 zone with a secondary harder to reach target X1 down in the 194 zone," end of quote. 13 weeks ago the market reached the primary target X, pushing down below it. However, we had a stall in the movement lower during the first part of March, prompted by the market trying to test down towards the 50% absolute Fibonacci line at 219. Please remember this 219 level and the 50% absolute Fibonacci line, as it will come up again soon. This action back then became very crucial to what happened next, beyond the obvious significance of it being a 50% absolute Fibonacci line. You see, it had importance because this level helped hold up prices back in November and early December last year, and also eroded the bearish incentive back in August and September as well. The reactionary rise only managed to move up to the gold long moving average overhead, currently at 226, not even testing it, but rejecting further upside pressure, and we dropped lower after that, more or less down to the lows that had not been seen since March last year. Anyway, 13 weeks ago I amended the still open further targets below into a secondary harder to reach target at 205 and a tertiary target X2, an even harder to reach target down at 194. I asked the question back then, and I quote, "The question still remains as to whether prices will take this time to form a possible bearish halfway hesitation, or will they recover further. The latter seems unlikely right now, and the former, well, it's too early to say, though it might comply with what is going on in the other grain markets," end of quote. I added 7 weeks ago, and I quote, "Comply? Well, the market did, as we've dropped down through the 50% absolute Fibonacci line and shown a new close in target X4 for the bearish halfway hesitation down in the 206 zone, which I've since finessed to the 208 zone. This is the most immediate opportunity on the downside," end of quote. 5 weeks ago prices reached the target at 208, and 2 weeks ago they reached the target down at 205. This just left the tertiary and much harder to reach target X3 down at 194 still open. I said earlier that the action over March was going to be very significant. Well, you can see by the March based bearish shift pitch hook that it was, as this pitch hook became excellent at showing the bearish angle of attack on market from March until 2 weeks ago, when we had changeover. Prices back then gapped up over the upper time, and last week pushed up through the 50% absolute Fibonacci line at 219. Also the grey short medium moving average, currently 215, and even the May 23 low at 221. However, by the end of last week and further into this week, it was clear that the market had not managed to stabilize over any of them. We are back today testing congestion on the downside at 211, and once more pressing the bright red seemingly significant breach, though I'm not too sure I would call it fully broken just yet. March 24 today uptrend, currently at 214. I think I may have to finesse that one soon, that uptrend. I'm going to have to move it lower. Thus, the mauve medium moving average is pressing down on the market, as is, after a fashion, the green short medium moving average, and prices are once more below the 50% absolute Fibonacci line. If these can be truly broken on the upside, then it would be a proper new development, giving a whole new series of market dimensions to contemplate. It will take some time to study, but for now I'll keep the tertiary so hard to reach target X2 below on my daily chart, and at the same time keep an eye on that 50% absolute Fibonacci line and the overhead declining mauve medium moving average and the gold long moving average. Minneapolis wheat. We have one key pattern to look here and a number of newer patterns and levels to discuss as well. Now the key pattern is the previously highlighted sideways triangle created by what is now the dark blue July 23 to May 24 downtrend, currently at 607, and the bright green early March to mid-May uptrend. After some hesitation over the last few weeks, prices finally pushed lower 3 weeks ago down to the slightly realigned September 2019 today uptrend, currently at 573. This was all before a changeover gapping move back up again. Now there is no bearish halfway hesitation to consider here as seen elsewhere, nor is there a 38.2% absolute Fibonacci line nearby, as that is down at 537. So it was a straightforward attempt lower, though we also had support down there, down at 578, and in the congestion seen between November 24 to January 25, between about 585 to 611. All this action left us until this week with some targets below. For the first pattern, the original sideways triangle, we have a primary target X in the 562 zone and a secondary hard to reach target X1 down in the 520 zone. I said 4 weeks ago about these two targets, and I quote, "I'm not too sure about these two, but for now they will do," end of quote. I was even more unsure about these targets below last week, as this whole move down looks very much like a quite large false break, and as I said last week, and I quote, we might in the next few sessions break on the upside with a new pattern, end of quote. Well, we have broken on the upside this week, pushing up over the April 24 low at 635 and now eyeing the overhead August 2008 high at 650. Yeah, we are definitely looking at that one. The nearby congestion at 652 and the 2025 high made back in February up at 659. Thus, after today, I will retire those targets below. Indeed, I can look at the action over this week and the last 2 weeks, and I can see a small bullish halfway hesitation that takes us up to the 646, 647 area, as over last week and the start of this week, that's when it's been formed, and the market has utilized primarily the October 2018 high at 611, the mauve medium moving average currently also 611, and the gold long moving average currently 614 as a base for this next move higher. London UK feed wheat. There continues to be here on this daily chart, even now, these many months, close to 1 year even, only one major significant pattern here, something we have not seen in the other grain markets, and that is the bright red late May to early July 2024 bearish shift pitchfork. The market in late February this year reasserted the dominance of this pattern, with prices breaching, then repairing an attempted break higher over the bright red upper time, currently at 173.55. Back in late January and early February actually. Now add to this the earlier this year narrow mix overhead of all the moving averages, though they are now separating out, as well as the 50% absolute Fibonacci line at 180.5, and you had, and I suppose still have, an area overhead that, as I've repeatedly said for months and months, had been brewing up for a significant move, which happened, or should I say started to happen, over late February and into March. I have been, as I've said 24 weeks ago and ever since, and I quote, even now still looking for that better pattern to appear. And until that shows up, I will continue utilizing the bright red bearish pitchfork, end of quote. So my point has been and still is that the bright red bearish pitchfork was and is, after all these temptations of other patterns, still the one key pattern I was looking for all the time. This leads me to my final 4 points, and 3 of them were something that I noted in my recent annual commentary on London feed wheat. Firstly, I saw there the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern akin to a double top formed after a big fall, such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2020 to date very large head and shoulders top pattern. These two super long term patterns are still live, and they both rely on one single feature, and that is their common neckline on my daily chart, currently at 167 3/4. For most of March, prices slid along the top of the support from these pair of necklines. However, Recently we dipped, recovered, and then dipped 5 weeks ago again below the neckline, setting up the opportunity for a recent bearish halfway hesitation with a potential target X in the 151 even zone, at the same time making the lowest lows and low closes since March last year. The third feature is a little more longer term. It is the March 2016 to date twice recently finessed dark blue uptrend, currently at 154.35. So for the last few weeks we had the market pressing on the necklines as well as the earlier version of this uptrend. I said 4 weeks ago, and I quote, "It looks right now as if we are finally breaking below it, as well as pushing down through the congestion between March to April 2019, between 161.95 to 165 3/4. And that's the end of the quote. Well, we finally did push down below it, as well as below, for the first proper time since July last year, below the bright red middle sign, currently 155 3/4, though we've not stabilized below it as yet. We now have support below at the February 24 low at 154 even, which held up prices last week, and the March 24 low at 153.65. I did say 2 weeks ago that it would be interesting to see how the market treats these two, and it was, as last week turned out to be, a weekly key reversal up, right at the lows of the market. However, there has been no follow through higher this week, with prices dipping, though still within last week's range. Now, going back a little bit, I've said here repeatedly that there was one major possibly severe criticism of these two necklines, and that is they had been previously breached, and some would argue broken. However, I counter that by saying that I transposed these from my longer term monthly charts, and whilst on a daily and even on a weekly chart they may appear breached and broken on the longer term monthly chart, where they really live, they did not look they did still look somewhat valid. And as I've also said here repeatedly, and I quote, "I would not take these as cast iron lines in the sand that should not be crossed, but as longer term strategic patterns that we should bear in mind and occasionally bring a closer eye upon, such as now." End of quote. I added 4 weeks ago, and I quote, "This week is the first week in quite a while when I really think we have broken the back of this support. We have not only had a significant monthly close below these key necklines, but we also did it with a monthly key reversal down. Now, 1 month does not make a major change in my monthly charts, but it does set up the situation to see if May and even June will follow through lower. Watch this space." End of quote. I still stand by those words. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.